Let's start at the very beginning. Corporation tax is a tax charged on companies, not individuals. That distinction matters because companies and people are taxed under completely different systems. In the UK, companies pay corporation tax on the profits they make during a specific period of time. That period is known as a chargeable accounting period. This is different from income tax, which applies to people rather than companies. Corporation tax applies to many types of companies. This includes UK-registered companies and, in some situations, overseas companies that have a taxable presence in the UK. So it is not limited only to businesses based entirely in the UK. When we talk about profits for corporation tax, we are not talking about total income. Profits mean what is left after allowable business costs have been deducted. This is a crucial point that often causes confusion. For example, if a company earns money from selling goods or services, it can usually deduct genuine business expenses. These include operating costs, staff costs, and other expenses incurred wholly for business purposes. What remains after these deductions is the starting point for tax. For tax purposes, companies do not simply pay tax on accounting profit. Instead, corporation tax is charged on something called taxable total profits, often shortened to TTP. This figure is calculated using tax rules, not accounting rules. Taxable total profits bring together different types of income a company may have. This includes trading profits, profits from property, investment income, and chargeable gains. All of these are combined into one taxable figure. The accounting profit shown in the financial statements is adjusted to arrive at taxable total profits. These adjustments exist because accounting rules and tax rules are not the same. This is why accounting profit and taxable profit are often different. Companies pay corporation tax for each chargeable accounting period. In many cases, this period matches the period covered by the company's accounts. However, tax rules limit a chargeable accounting period to a maximum of 12 months. If a company prepares accounts for longer than 12 months, that single period must be split. It becomes two separate chargeable accounting periods, each taxed separately. Shorter periods can also arise, for example when a company starts trading. Once taxable total profits have been worked out, the corporation tax bill is calculated. This is done by applying the relevant corporation tax rate to those profits. The rate applied depends on the timing of the accounting period. Corporation tax rates are set by reference to financial years. A financial year runs from the 1st of April to the 31st of March. This does not always align neatly with a company's accounting period. If an accounting period falls entirely within one financial year, a single rate applies. If it spans 2 financial years and the rates differ, profits are time apportioned. This ensures the correct rates apply to the correct parts of the year. Corporation tax does not always apply at one single rate. The rate depends on how large a company's profits are, measured against specific thresholds. Profit size matters for how the tax is calculated. As at September 2025, and subject to change, companies with lower profits may qualify for a small profits rate. Companies with higher profits pay the main rate. Companies in between may fall into a marginal zone where relief applies. These thresholds can also be adjusted. Adjustments apply if the accounting period is shorter than 12 months, or if the company has associated companies. These factors can change how the thresholds work. Putting it all together, a company works out its taxable total profits for each chargeable accounting period. The correct corporation tax rate is then applied. Adjustments are made where periods overlap different financial years. The final result is the corporation tax liability for that period. This is the foundation of how corporation tax works in the UK. Later episodes will build on this by looking at associated companies, marginal relief, filing returns, and HMRC powers.